I'm very happy to be here and be able to give this talk. Until this July, I was a member of Columbia-University, which is not quite Princeton. I'm now a member of Technische-Universität, which is not quite Humboldt, and so I'm very happy to be at the Humboldt-Princeton conference, where I'm not quite, but I'm happy to be here nonetheless. Okay. So what I'm talking about today is joint work which I'm doing with Dmitry Kramkov, and what we are concerned with is to develop a model which would allow us to understand a little bit better how one should behave optimally in an environment where trading will influence market prices. Specifically, what I'm planning to do today is, well, I'm going to talk a little bit about modeling asset price dynamics. I will describe a model in a very, very simple setup. So that's just to illustrate how things should work. And then I do what mathematicians always do. I generalize this beyond reason, which will involve some economics and some mathematics. And yeah, a conclusion will also be offered. All right, so asset pricing. Well, what we want to do is we want to understand how prices are formed in the financial market. In mathematical finance, this is done, one takes the highway and just says, okay, let's specify those dynamics just exogenously. So we write down geometric boundary motion. We write down whatever semi-martingale model we like. We saw a number of these in that conference here. And then one uses tools, mostly from stochastic analysis, to understand these dynamics, to understand the implications, let's say, for option pricing. And indeed, it turns out to be a great success story. This becomes very tractable. And we can talk about things like hedging. We can talk about replication. And it's also very easy to handle these models. Easy, of course, relative terms. Indeed, you only have to look at what volatility is going to be like in the future, and if you know that, you can do a lot of things. Basically, all the things that one really cares about, at least in equity trading, well, they can be done with volatility knowledge. Now, so that's pretty good because, it becomes very tractable. However, certain issues arise when you think about products where correlations become an issue, because correlations are something which you would have to specify ad hoc in such a semi-martingale model. Semi-martingale model like geometric boundary motion, you take two of them, okay, there's a relation now between them, but you have to postulate this a priori, right? You have to say, okay, that is the correlation, and then you have to work with it, and this is also exogenous. But of course, typically when we think about something which could be correlated, we assume that there might be some common factors driving these things, and we have seen models which try to address this, but it's always an issue how to get up, how to come to terms with this. So Ronnie, for instance, presented work which was addressing issues related to correlation and how one can model it. Now, this is not what I am focusing on here. I'm focusing on another aspect which is neglected in such an exogenous approach, namely the issue that when you deal in a tight market, you will move prices, or in other words, if you want to apply such an exogenously specified model where prices just fluctuate as you specify them, well, then you should better be in a very liquid market, or you should better be trading in small volumes so that you do not influence market prices. So this is what, however, Deutsche Bank sometimes does not do, and this is why we investigate this in our QP lab. And the suggestion which I am going to give here will hopefully be investigated there a little bit in more detail. Now, mathematical finance is not the only discipline which worries about asset prices. As a matter of fact, there is this dismal science of economics, which also worries about prices and has a very nice paradigm when it comes to price formation. We should look at demand and supply, which of course is not done when we do Black's codes, right? Geometric boundary motion is symmetric boundary motion, regardless of who is demanding what. Yeah? So, and of course, economics has also developed its tools. Equilibrium theory is the main toolbox we can look at. And yes, it's built on this wonderful price formation mechanism. It has excellent qualitative properties, and it can account for integrate interdependencies. We see how risk sharing is being done. We saw Ulrich talk about this. We saw Patrick talk about risk sharing in some form. And so we have in economics a better way to understand interdependencies. However, when we want to use such models, we have to specify a whole lot of different things as inputs, such as endowments and preferences, which are not observed in financial markets. So when you go and then want to have a quantitative assessment of the situation, then you are in trouble, because whatever you compute as numbers, you cannot really rely on these numbers as much as one is used to be able to rely on the finance side. So nonetheless, okay, the pricing formation mechanism here makes, in a sense, it makes much more sense, in my opinion, than the one which we have here, where we just postulate something out of thin air, more or less. And so one issue which one could address is well, how to possibly bridge the gap between these price formation principles. Yes, please.
Just on that point, I mean, is it fair to say that the difference between endogenous and exogenous is just that you postulate things out of thin air 2 levels back?
Yeah, but you see, when you want to specify, okay, I'm talking about large investor models, right? And the question is, how do you specify such a thing? So you know you cannot use Black's codes anymore, so what do you use instead? But you worked on something which was related to this, but you also specified something ad hoc, and then you analyzed it, and you said something about the implications.
So
but
when you say endogenous, isn't it something else?
Yes, well, I will show you. I will show you a way to endogenize this, of sorts. Yeah. So I'm not claiming that this is the end of the last word which is going to be said on this, but I hope it's going to be some progress. All right. So the goal is to bridge the gap between the two. However, I'm working for quantitative products laboratory, which is meaning I'm based, at least also from my upbringing as a scientist, more on the math finance side. So what I will do is I will follow the basic principle and stay close to Black's codes. This is not only for convenience, it's also important, I think, because Black's codes has proven itself to be wonderfully useful in finance. Also, the traders are used to communicate in that language, and so if you want to communicate a new paradigm or a new idea to them, you should better have Black's codes in the cards to illustrate your digression from what they are used to in a systematic way. Now, for us, when we want to investigate what a large investor does, it means that when a large investor is actually small, we should be back to Black's codes. And so when we look at wealth dynamics, well, let's say our investor follows some strategy Q, then we could have a small investor actually acting, that is, we multiply that strategy with a small quantity epsilon, and then to the first order at least, we should like to see that we are back to the Black's code situation where we just integrate the quantities against the changes in prices, and that's what we get as our terminal wealth. Now, of course, there will be some corrections, but these corrections should be of higher order than our first order approximation, which is the Black's codes or the classical math finance approach to wealth dynamics. Now, another thing which we want to be able to do is we want to be able to compare our strategies to Black's code strategies. It is in particular the Black's code strategy space should be included in the strategy space that we are talking about for a large investor. So we want to have any particular strategy included in the set of strategies Q. And then when it comes to option pricing, which of course is our ultimate goal, well, or at least one ultimate goal, we again want to recover the Black's code prices, at least to first order, and then there will be some corrections, and these corrections should be interpreted as something like a liquidity premium. Yeah? So you have to pay different prices in such a model, but only on the second order, at least when we talk about small exposures, and the means we need to hedge against those exposures. Now, how do we specify our dynamics? Well, our main idea will be dynamic indifference prices. So this is what we are going to use, and this is what I'm going to illustrate in the next few slides in the most simple case we can possibly specify. So the situation is a two-player situation. One player is, or not player, but one market participant is a market maker. So this guy is marketing a product which is specified by some, well, terminal value of a Brownian motion. So we look at F, the payoff at time capital T, which is some exogenously specified quantity. So you could think of S as being something like a weather derivative or whatever, something which just happens to produce a value at time capital T, which, well, is not debatable. It's clear what it is, and it becomes clear at time capital T. And as time progresses, we get to learn more and more precisely what this value is going to be, namely as Brownian motion evolves from time 0 to time capital T. So that's the common thing. Now, to keep things simple, we also assume that our market maker can invest in nothing but the money market, where he doesn't even earn interest. So that's Very simple. And then what does he do? Well, he offers us to deal in that instrument, in that F. So what he will do is he will quote prices whenever we come along as an investor and want to take positions, and he will do so in such a way that his position before the transaction is as good as his position after the transaction. So this is this indifference principle which we were mentioning earlier. And to quantify what it means to be as good as, well, we introduce, as usual, preferences, and more specifically, we will look at exponential utility to describe our market makers' preferences for positions at time capital T. So this is this alpha here, which is the absolute risk aversion of the agent. Okay, so that's the market maker. Now comes along an investor and wants to deal with this guy in a dynamic way. So at time 0, for instance, the guy could ask the market maker, okay, please sell me Q of those claims F. So market maker will say, yes, of course, I can do this. The price is P0 of Q, and how is it determined? Well, it's determined by comparing the exposure the market maker had before the transaction. Let's assume that there was no exposure initially, so there is 0 exposure, and then the utility would be U of 0, and he compares that to the exposure he would have afterwards when he has sold those Q claims, and he has got some money at time 0, which is exactly the amount of money we want to determine right now. But this is a very easy thing, right? U was the exponential utility, F is the bounding motion at time capital T, so we just do some little bit of algebra, and this is the price that we find. Fair enough. Yeah? So now this is what we pay at time 0. At time 1, okay, the whole thing is reversed. So our investor comes along and says, okay, listen, I'm sick of this thing, I want to get rid of it. Please take back those Q claims. And the market maker says, yes, of course, I can do this. And here I can pay you P1 of Q for those Q claims. Where P1 of Q is determined in exactly the same way. It's again comparing the transaction, sorry, the position before the transaction with the position after the transaction. But now, of course, given the new time information at time 1, which means that rather than having W0 here, we have W1, the bounding motion at time 1. So we know the present value, and we have a reduced variance term. So here we also have to take into account the variance, and here the variance is reduced because we are one step closer to the revelation of the true value of F. So there's less noise now in the market, and this is reflected by that. And now our investor can, of course, go and compute his P&L from that in and out. So what he sees is, well, I paid that much, I received that much, which then can be decomposed into these two terms here. One is the usual P&L which one would see in a liquid market, right? Quantities times changes of prices, whatever prices is supposed to mean in that context. But then we have this additional term which is emerging from the difference of those variances, and which happens to be always positive. And this is something which we interpret as a liquidity premium in that model here. So the alpha, which we first introduced to be the market maker's risk aversion, now turns into the market's illiquidity parameter. The alpha measures how illiquid the market is, as alpha is 0, which corresponds to a risk-neutral market maker, or a perfectly liquid market, which means a market which has linear wealth dynamics. Well, that's alpha equal to 0. If alpha increases, then we see these liquidity premia emerge, and we see a deviation from the linearity in the prices and in the wealth dynamics.
Do you distinguish between the buyer and the seller price?
No. No, so you ask for Q, you can ask for minus Q, and then,
oh, I see.
yeah, so, yeah. All right, so these are the wealth dynamics as of time 0 to time 1. We, of course, can generalize this to arbitrary numbers of transactions. As a matter of fact, we can go to continuous time, where we would now look at the wealth at time t, which is generated by a strategy Q. Of course, we have the usual integral term here, and we have this liquidity premia term coming in exactly from these contributions here. So you just sum up all of these, or you integrate these over time, you integrate these over time, and this gives you those wealth dynamics here. And indeed, when you do all this, you realize that you are, at least looking back at our catalog of the desirable properties, that you are doing a good job insofar as you have a wealth dynamics which to the first order becomes the usual Wex-Golds thing if you trade small quantities at all times. Yeah? So a large investor, which is actually a small investor, at least according to our application here with the epsilon, behaves like a small investor. And of course, you also see that the wealth dynamics which we generate here are reasonable in the sense that we don't have arbitrage opportunities. After all, we don't have arbitrage in the linear model, and here things are even worse from the point of view of the investor, so it cannot be that there is arbitrage here either. All right, so that is the model in the simplest case, and we can test it a little bit at least and ask questions like, okay, can we hedge in this model? So this is, after all, what we want to do. We want to understand how our investor can use the market maker's product in order to hedge some exposure, let's say an exposure G, which is depending on that Brownian motion W. So some derivative which is written on, let's say, the weather forward or so contract which is being marketed by the market maker. Now, how is this done? Well, okay, we have these nonlinear wealth dynamics. We can ask, okay, is it possible to steer these wealth dynamics into that target payoff G? And yes, indeed, it is possible to do this. And it's possible to do this starting with initial value, which is given by that quantity here. So if you want to start replicating at time t, what you need in your pockets as an investor interacting with the market maker is this thing here, which the trained eye recognizes easily is an indifference price, but for G, for minus G to be precise. So it's the market maker's indifference price for minus G, which you have to have in your pockets when you, as an investor, want to start replicating a claim G using the instrument that the market maker offers you to deal in. Now, this is something which we found quite interesting and illuminating because it shows that the market maker's attitudes towards risk is entering into the pricing of derivatives in very much the same way as the market price of risk in the Black-Scholes theory applies to stocks. Of course it does, this is where it comes from, and to derivatives. So this is the same mechanism here, but we see it really at work because we see people interacting and we see people transferring risk premia from one instrument to the other, exactly through that mechanism.
Can I ask something?
Yes, sure.
So you have expected exponential utility?
Right now, yes.
Okay, later you're going to show us other?
Yes, as I told you, I'm a bloody mathematician. I'm generalizing everything. Yeah, so that's the lemma here with the replication price, and of course you can really replicate, you can compute replication portfolios, and to just illustrate that it a little bit makes sense what we are doing here, let me show you the liquidity premium that one has to pay for a call option on that underlying. So first of all, one can compute all of this in closed form, no problem at all. It's just an expectation in a Brownian setup, so no problem there. And you also see that the premium kind of makes sense. Indeed, if you look at the moneyness of your option, and if you look at the illiquidity of your market, which was the value alpha, this risk aversion parameter, well, then the premium, the extra money you have to put on the table in an illiquid market increases depending on the moneyness of your option. It is the closer your instrument, that is your call, is to looking like equity, like the illiquid F, the closer the liquidity premia are going to be. So if we are, well, way in the money, then it means that our option is basically looking like equity, and indeed it suffers the full liquidity premia which we have to pay as liquidity rises. But if it's far out of the money, it's basically cash, it's not worth nothing, and it's worth nothing both in the illiquid and in the liquid situation. So there is no differences here either. Now, this is just reassuring in the sense that, yes, we don't get stupid predictions from our model, and we should always expect something like this. A question which is maybe more subtle to ask and it's only possible to reveal the answer, at least in our model, is the one what happens to hedge ratios. Let's say you have written that call option, you want to hedge yourself against that. Now you compute Black-Scholes hedge ratios, and, well, you know how to do that. Now I tell you, okay, listen, the market is not actually liquid, it's illiquid in the sense which I just explained. You have to pay this premium. What about your hedge ratios? Would you have to take larger positions or smaller positions? Could it be either or, depending on what the moneyness is? So that's a question which one can ask a trader, and I have not found a single trader yet who could give an answer to that question. Neither can I can compute this thing, however, and turns out one has to take larger positions. So in the illiquid world, one always takes larger positions, but in a kind of nonlinear way, so which I don't have an intuition for really, but our model at least allows one to compute such things. Now, this is all nice and well, and you can go on and play around with things like that indefinitely. I will not do this. Instead, I will do the generalization now. So there was already the demand for this. So one thing one can complain about, okay, this is one ball in motion, and of course we are dealing in the financial market with a large array of assets. So can we do with more than one underlying, in particular underlyings other than ball in motion? Also, the utility functions are here of exponential type, which is very convenient to do the math. However, it's not realistic, at least it's not obvious why anybody should have exponential utility. It's also interesting to ask a question, okay, this was one market maker, but in the market there are several market participants. So if I, as an investor, go to the market, I have a bunch of guys that compete for business, a bunch of market makers, namely, and how do they do this? Another question which one could ask, okay, these market makers do not actually take the risk and sit on it. They will reshuffle it. They will manage this risk. And you could go on and ask, well, what do we do if there's more than one investor? And other questions like this. Now, in this talk, I will give answers to the first 5 of these questions. The 6th question is a PhD thesis currently being worked on in the lab. And there will be more of these theses coming along. And I will, in the end, discuss a little bit what other issues one can investigate. So how do we generalize this? Well, let's see. Of course, we give us a general setting, first of all. So this is the usual one of a filter probability space, where we have an information flow described by some filtration. We now have our market makers, and yes, they don't have exponential utility, but they have they have utilities which are not too far off. Indeed, we look at the absolute risk aversion coefficient, and we just assume that these are not constant as in the exponential case, but bounded away from 0 and from above. So we have bound absolute risk aversion, which is meaning that they are reasonably close, but not exactly exponential utility. This is for technical reasons, of course. Now, technical stuff comes in. We also deviate from what we had before in that we allow our market makers to have initial endowments. So they have exposure to whatever kind of risk, and this is described by a random variable known at time t only. And we assume these endowments to be spread over the agents in an efficient way, in a Pareto optimal way that is, which corresponds in a sense to saying that, okay, these market makers, when they reshuffle risk, they actually call each other and make deals as exactly it happens in the OTC market at all moments, right? So there's a huge array of different instruments marketed at the OTC, OTC-wise, and then, we assume that this is done really efficiently so that everybody can, that the whole market is in the Pareto optimal allocation before we enter as an investor and make our requests. And of course, we allow claims to be more general, so that this is just a bunch of payoffs maturing at time t, so this is European style options, and we throw in some integrability to make things work neatly. So that's the model. And now, well, our market makers are specified, their endowments are known, and we can ask the same question, how will they interact with an investor who comes along and asks for a bunch of claims? Now, what we have to keep in mind is that there is a pre-transaction endowment for our market makers. Our investor submits an order for Q claims. And then, of course, the total endowment of our market makers will change after the transaction. They will have sold those Q claims, and there will have been a cash transfer from one to the other party. Yeah? So the market, for the investor to take the position Q, he has to pay minus X to the market makers, right? And then, don't worry about the signs, yeah? So just take the plus as it is, and this is how we decided to do it. So after the transaction, the market makers have gained some cash or lost some cash or got some cash. Anyhow, there's a change in cash, and there is additional exposure at time capital T, namely the one which corresponds to the position Q our investor wants to have. Now, as I told you, we assume that there is this complete OTC market, which then allows these guys to call each other and reshuffle that endowment in a Pareto optimal way. Yeah? So this forms a new endowment, E1. So we have a transition from E0 to E1, which depends on the order of our investor. Now, of course, this is not completely specified right now, right? So there could be many ways this could be reshuffled. There could be many compensations X, which one can look up at. So the question is, how exactly do we want to make this transition work? And this is where the first result here comes in, which says that, okay, if we insist on our indifference principle, that is, if we want to have that after the transaction, the endowments of our market makers give them utilities which are exactly as the utilities which they were looking at before, then this can be done in only one way. There's only one cash transfer X, and there's only one Pareto optimal allocation of that cash transfer and the other total endowment which the market makers must have, which will make this transaction work. So we have a unique way to go from the initial Pareto optimal allocation to the one after the transaction if we insist on utility indifference for all the market makers. And for that reason, we can call the cash transfer X here as the market maker's indifference price or the market's indifference price for this position Q. Now, an interesting property of this capital transfer, this cash transfer X, is that it is actually the minimal amount of cash which has to change hands to make this transaction work in such a way that nobody is worse off than before. So in a sense, if at all our investor can hope to have this transaction to go through, and if he believes that indeed the market makers will not give away something for free to him, yeah, so that they are willing to lose in terms of utility, then the cash transfer X, which we are talking about, is the least amount of capital which has to change hands for this to go through at all. So this is the most friendly market environment for our investor, which also becomes clear from the following consideration. A somewhat unusual feature here may be that the market makers don't gain in terms of utility, right? So why does this happen? Well, there are many ways you can explain this, or many ways you can characterize this to happen. The first thing is that you can say, when our market makers quote prices, they do not anticipate any further trades from the investor. So they do not make guesses about, okay, he has bought now, he will buy more tomorrow. No, there's no such guess, which amounts to saying that, okay, whenever these market makers are confronted with two strategies which coincide up to some point in time t, well, they will quote the same prices all the way along, and they will not, well, make wild guesses about what might happen in the future. So the same prices for the same strategies, of course, if they deviate afterwards, we will see different strategies. And then, as a result of this, it happens that the investor, whenever he is confronted with that necessity to make a sizable transaction, what he can do is he can split it into small pieces, which then trade at marginal indifference prices. So these small pieces don't really disturb the market too much. But then, as he does this, well, he will integrate along the indifference curve and then unwind his transactions this way. And at all these little transactions, there's no changes in utility. So since no changes in utility at all these small transactions, the global transaction will also not cause utilities to change. And that's another way to look at that, which then, as a result, has indeed the indifference property here. Now, is this the only way that markets can function? No, it's not. We have seen the Arrow-Debreu setting, which, of course, is the hallmark of equilibrium theory, where we also see discussions of how an investor entering a market will affect prices. But there, the situation is slightly different from what we are looking at. Indeed, what happens in their setting is that an investor who enters such a market typically will be assumed to reveal his targeted position, he will reveal his strategy, and he does so at time zero. So he says at time zero, I will do this and that, and I want to achieve this goal at time capital T. Information which is not available to our investors, or our market makers, I should say, in the setting which we were discussing. And so since the market makers know about his future plans, they can take this into account when forming the Pareto allocation which accommodates his request. And then, well, since they gain in information, they also can gain in terms of utility. But here, this is not the case, and this is why one could argue utility stays the same. So the equilibrium setting which we have is different in that respect from the Arrow-Debreu setting. Okay, so we have that recipe which tells us, okay, we have an endowment, we want to accumulate a certain request Q, we have a unit cash transfer with X and a new way to allocate the overall risk among the market makers to make all of this happen. Now, we can iterate the whole thing so as to go away from this one-shot scenario where we have only one transaction to a bunch of transactions, let's say, for a simple strategy Q, which reshuffles the portfolio at some deterministic times Tn, well, in the usual way. We will find cash transfers which correspond to these rebalancing moments. We will also find a process of Pareto optimal allocations which accommodate the requested positions. So we will have this process ET here. And of course, in the end, we will have a certain cash balance for our investor. That is, he will have assumed a certain position in the underlying claims, and he will have a certain cash amount in his pockets. Of course, a dual way to view this is that we can say whatever the investor has in the end, well, it must have come from the market makers. So if these had that amount in the beginning and that amount in the end, then the difference between the two should be what has gone to the investor. And this is one way to specify the wealth dynamics, at least for simple strategies. So for simple strategies, we know that it's possible to make these transitions and to compute, at least in principle, such wealth dynamics. Now, what we want to do is, however, we want to do a continuous time model. We want to be close to Black's codes, right? So we want to have a specification of these wealth dynamics which would apply not only to strategies which rebalance at finitely many times, but actually at all these continuous times in between time 0 and time capital T. Now, the mathematical challenge arises from this, that now we want to have this consistent way to pass to the limit, that is to pass to predictable strategies as integrators in this business here. So how can one do this? And well, this is starting the math part of the talk, so my apologies to those who are economists and don't want to follow. Well, don't, just suffer through this and look at the following technical assumption, observation, I should say, where we realize that, okay, when you want to study this dynamics, what you have to know is the market state. The market state is characterized by the present endowment of the present allocation of endowments among the market makers. This is the most important ingredient. This, however, is a random variable, a collection of random variables actually, so that the process of endowments is a process that takes values in the random variables. And this is something which you don't want to study. You don't want to study the process because you will run into all kinds of technical problems. So it was very revealing to us that we could find what one could call a sufficient statistics which captures the market's state perfectly, which is given by the market makers' utilities, the indirect utilities. That is the utilities you can observe at time t. So they have at time t a certain endowment, and all that we really need to know is not the endowment, we only need to know the utilities. And from that, this lemma here says we can reconstruct the cash balance which has been, the cash transfer, which is the net cash transfer which has been done up to time t, and we can reconstruct the full allocation of the full Pareto optimal allocation, which corresponds to any possible observation of utilities at time t. So this is saying that instead of studying the dynamics of the market in terms of endowments, we only have to study the dynamics of the market in terms of expected utilities. And that's, of course, an RM vector valued process, and for that reason we can do analysis quite conveniently here. Indeed, if we introduce a number of assumptions which we find quite annoying and which we are working on to weaken them, then we can specify SDEs to make things work. Indeed, let's assume that we are working with a Brownian motion, so yes, we are close to Black's codes. We don't have to be, we believe, but at the moment this is what we can do. Let's assume that our contingent claims are nice contingent claims, so Brownian motion in particular is nice in the sense which I have written down here. What we also have to assume, and that's, I think, not a technical assumption, but actually necessary, is bounded prudence. That is, we have to assume that the ratio between the third and the second derivative of utility is bounded. Again, technical points here. But if you give me all that, I can tell you that, okay, remember we have the utility process of our market makers as the sufficient statistics for our market. Well, the dynamics of this thing are of course determined by the strategy Q, which our market or our investor chooses, and the way this happens is via a stochastic differential equation. It is the change in utilities of our market makers is determined by the choice of the position our investor wants to take, by the vector of utilities we currently observe, and by the shock our market experiences at this point in time t. And of course this is all mitigated through this field G here, which I'm not going to talk about. But you can compute it. And you can show certain regularity properties for this, which then show you that indeed there is a unique strong solution for this thing here. At least for all simple strategies you can do it. And indeed for simple strategies this is consistent. So you can look at this STE, solve it for Qs, and then you get the utility process U. But we also had a way to compute the utility process for simple strategies from this transition mechanism which I described earlier, this simple strategy use. And this is the magic of this word here, that we find this field G here, which is describing the dynamics of U for simple strategies, but then, of course, for any strategy, right? Because the rest of the story is then just stability theory for STEs. So we have a simple strategy, we know how to specify dynamics, we have seen that we can view these dynamics as a special realization of a stochastic differential equation. Yep, I'm almost done. Yeah. So, and now the stability theory is that is saying that, okay, if I have a sequence of let's say such simple strategies which approximate an arbitrary predictable strategy Q in this quadratic sense, then indeed we can show that the corresponding utility processes, and for that reason the corresponding market evolution converges in a uniform sense to the one which would be emerging from Q. So we really have what one wants to have in models, that stability holds true for your dynamics and for your system. And in particular, we have now a very convenient and transparent way to extend that terminal wealth mapping from simple strategies to strategies at time t, because we know how our utilities evolve. And as I told you, this is the sufficient statistics which you have to know in order to reconstruct the full market. And for that reason, well, we have gone all the way from simple strategies and the exponential utility function now to several market makers and arbitrary strategies. One can now start the analysis again, ask about replication prices and stuff like that. And this can be done under suitable assumptions, such as the Brownian motion is the underlying. So we are having market makers that trade maybe a multivariate Brownian motion as an underlying, and then one can again show there is a unique replication price. It can be one can compute the replicating strategy and stuff like that. Instead of doing all this, I come to the conclusion and would like to remind you that we have seen a way how to derive price dynamics, let's say, from first principles in an endogenous way. We saw that this indifference pricing principle leads to nonlinear wealth dynamics which include liquidity premia. I illustrated that we can have something like a complete market with this nonlinear world, where indifference pricing yet again emerges now for the pricing of derivatives. We can compute explicit formulas for hedging strategies, and we find these to be compatible with Black's codes in the sense that small exposures will be hedged like Black's codes, large exposures will be hedged differently. We saw that all of this generalizes to several market makers, and we don't have to use exponential utility, at least not necessarily. And we saw that we can do some stochastic analysis to have the full-fledged generality of strategies also on that level of our modeling. So this is what we saw. What we haven't discussed is the case of bounded relative risk aversion. So you can look at power utilities which don't have absolute risk aversion bounded, but just the relative risk aversion. But this can be done. It's a little bit more technical, but it's definitely in the cards. Market resilience, that is the tendency of markets to recover after a transaction, is not captured by this model here, right? Because we do a transaction, leads to a new Pareto allocation, it stays the same all the time. So there's no recovery or whatsoever, it just stays put. This is something which we will look at and see how one can bring this in here. I have some work with Dirk Becherer where we have a different model which allows one to do this, and there are some ideas how to incorporate this market resilience here. Of course, we assume at all times that there is a market. So if you have a complete lack of counterparties at certain points in time, such as in work by Duffy, then of course this is a different story, and we do not say anything about that. But then one could always argue, okay, you will always find somebody who takes it from you. You only have to ask for the right price. I mean, the complete lack of counterparties might not be that much of an issue. It might be that you have to realize sizable losses. A more interesting question, however, is that one should also look at manipulable claims. That is, claims where we have the following situation. We have a claim. So let's look at the underlying which we have so far. This underlying is going to be traded at these market indifference prices, and then there might be a derivative written on that underlying, which might be path dependent, right? In that situation, we can manipulate as an investor the path of that underlying, and for that reason the payoff of that derivative. Now how this can be handled is still open, but there are certain ideas how to do this, and again this is something which we will investigate in the lab and will be happy to report about in due course. Right now I'm stopping right here, and thank you very much for your attention.